All right, it's March 16th, 2026. Right now, there is one dominant framework driving global markets, and we're calling it the energy first regime. Today, we're going to break down the causal chain that explains everything from oil to equities, all the way to Bitcoin. You see, it's a single causal chain that really explains the price action across all asset classes. If you can understand this sequence, you're going to understand today's market. So, what does this chain look like? Well, here it is. It all kicks off with an energy shock. Now, that shock fuels higher inflation expectations, which in turn pushes yields higher and gives us a stronger US dollar. The knock-on effect? You get fragility in equities and, interestingly, a notable resilience in Bitcoin. The key point is that every single asset is reacting to this sequence. Okay, so let's walk through each link in this chain, starting right at the source of the pressure. So it all starts with energy. You have to understand that the price of oil isn't just some commodity story right now. It is the beginning of the macro narrative, and it's what's sending pressure across the entire financial system. The key variable to watch here is Brent crude. It's currently holding around $105 a barrel. And that price level, well, that's the anchor for this entire macro chain that we're seeing play out. So why are prices staying this high? Well, there are a couple of key reasons. First, you've got supply, which is still constrained, largely due to underinvestment. Second, and this is a big one, geopolitical tensions are disrupting major shipping routes. That's adding a pretty significant risk premium. And when you put those two together, you get this persistent volatility that just keeps fueling those inflation fears. Okay, so how exactly does this pressure in the energy market transmit to financial assets? Well, it flows directly through inflation expectations. And that, in turn, forces yields higher and strengthens the US dollar. And, these two factors, yields and the dollar, they really are the primary transmission mechanism. This is how a shock in the physical energy market gets translated into real pressure on financial assets. Right now, the 10-year Treasury yield is holding firm right around 4.1%. And that's a critical level. It reflects how the market is pricing inflation, and it is actively right now tightening financial conditions. And the combined effect of all this is pretty significant. You see, higher yields and a strong dollar, they tighten global liquidity, and that creates direct headwinds for equities. This dynamic also puts pressure on other commodities and really influences the performance of global stocks. All right, so given all that pressure, how are different risk assets actually responding? Well, the picture is pretty divergent. The details here really matter. Now, you might have noticed that equities saw a bit of an intraday rebound as oil prices eased off for a moment, but you have to see this for what it is. It appears to be a technical, flow-driven move. We're talking short-term positioning adjustments here, not a fundamental shift in the outlook. The underlying macro pressure from energy and yields, that remains firmly in place. Okay, and here's where we see a crucial divergence between gold and Bitcoin. Gold, you see, is basically range-bound. Why? Because a strong dollar makes it more expensive, and those high real yields, well, they offer a competing safe haven asset. Bitcoin, on the other hand, is holding strong, above $74,000. It seems to be benefiting from this steady institutional demand that sees it as a hedge against the kind of monetary debasement that often comes after a period of energy-driven inflation. All right, let's put some numbers to this and take a quick look at the market's vitals. The volatility dashboard really tells the story. Energy vol, it's elevated, and that's what's driving all the caution. Equity vol is actually moderate, but it's the persistent bond volatility that shows you the market is still really uncertain about the path of yields and inflation. And this risk map just pulls it all together. It summarizes the entire regime. Look, the pressure is clearly upward for oil, for yields, and for the dollar. And what does that do? It forces gold to trade sideways, while both equities and Bitcoin are fighting to hold their ground with some resilience. This is really a classic picture of an energy-driven, tight liquidity environment. So, if this is our framework, what should we be watching? What are the key catalysts to monitor? Let's turn to that forward-looking picture. Okay, there are really three main areas to keep a close eye on. First, any new developments on the energy supply side. Second, how are Treasury yields going to respond to any new incoming data? And third, how long can equities really withstand this sustained energy volatility? A shift in any one of these could alter the entire chain. And all of this leaves us with the single most important takeaway. In this market, the traditional focus on economic data has to take a backseat. The correct framing is energy first. If you want an edge, you have to understand the start of the causal chain because that's what gives you the clarity to navigate every other asset class. That is the regime we are in.